Good morning. My name is Larry Cada. I'm the employment coordinator for Midwest Shelter for Homeless Veterans. Today, I'm going to be discussing credit, credit history, credit reports, credit scores. And so what I'd like to start off with is some of the advantages and disadvantages of using credit. So one of the main advantages of using credit is to help one obtain, meet a goal or obtain goods and services that current immediate funding might not be available for. And so other advantages is that building a credit history can help establish the ability to obtain credit in the future for larger, more important types of items. Also, credit can be a quick source in cases of emergency. Use of credit cards, if used properly, when paid on time, the full balance, usually you pay no interest. So you can use temporarily other people's money, the credit cards company's money, for 25, 30 days without having to pay for it until later on. So that's usually if you have a no interest credit card. Also, credit cards and credit can help reduce or totally eliminate liabilities associated with either fraudulent purchases or with purchases of items that were misrepresented and aren't really as they were advertised to deliver them. Credit companies usually will erase those types of charges, and so you wouldn't have to be liable for those. And so that's an important consumer protection type of a benefit that they can get from the use of credit cards. Now, what are some of the disadvantages of credit card? Some of the disadvantages are that if you rely too heavily on that credit card and all of a sudden you've reached your limits or are unable to obtain further credit when you were expecting to, you might have been deemed not to be worthy of any additional credit, and all of a sudden you're in a bind because you relied on the use of that card and now you can't use it. Also, a disadvantage would be is that you could use the card to do impulse buying of items that you might not need and just right away, just because you see it and something clicks that you want it, you buy it, and you later on decide, well, you really shouldn't have purchased that. Now all of a sudden you're committed for it. Some credit cards have high interest rates, and the finance charges can mount up rather quickly with those. Some credit cards have annual fees associated with them, which again is additional cost for items that you buy. Credit cards usually have fees for late payments, or they have fees for payments if you pay with a check that is later found to have insufficient funds. And those fees can be substantial. And also, a negative disadvantage of credit cards would be is that it could possibly have a negative effect on your credit history, your credit report, and work against you in the future. So those were some of the advantages and disadvantages. And so just as a kind of a benchmark of how credit-worthy a person is, one of the tools that lenders use as a kind of a benchmark is something called the debt-to-income ratio. And very simply, what it is the total amount of your monthly debt and divided by your monthly, all the sources of your income for that month. So, for example, if your monthly debt payments are running $1,400, and say that your income, say approximately $50,000 a year, which would work out close to be $4,100 a month. You would divide the $1,400 worth of your monthly debt payments. You would divide it by the $4,100, and what you would come up with is a percentage ratio of 34%. Now, lenders, as a rule of thumb, look at a debt ratio of approximately 36% as being, a good point, where anything below that they would deem the borrower to be creditworthy. Anything above the 36%, they kind of view it as that you may have problems paying off your debt in the future. And so, for example, using that same example of a $4,100 per month income, say your expenses, your debt expense monthly was $1,600, just an increase of $200 over the other one. That ratio, $1,600 over the $4,100, comes out to be 39%. That's higher than the benchmark 36% that lenders like to see. And evidence from studies of mortgage loans suggests that borrowers with a higher debt ratio than 36% are likely to run into trouble paying off items. So lenders would like to see debt ratios of 36% or less. And so you can calculate your own, and you can kind of determine whether you're sitting on the fence, whether you're real good, or whether the picture doesn't look too good for you. So the next thing I want to talk about is that all of your uses of credit are gathered up by different credit bureau agencies, and they kind of track your uses of credit, how much you borrow, how much debt you have outstanding, what your credit history, or what your payment history is whether you pay on time, whether you pay the full amounts, whether you pay less than the full amount but you pay on time, or whether you're late 30 days or 60 days or 90 days. And they assemble these things into a credit report known as your credit history. The three main reporting agencies are Experian, Equifax, and TransUnion. And they keep track of your debt and your payments. And and these are public knowledge, and they are available to you. Each of the reporting agencies is required to provide you, or an individual, with one report annually free. And so what many people would do who are tracking their credit histories and their credit reports is they would, the first 4 months of the year, they would get the credit report from one of the agencies, say Experian. The next 4 months, they would obtain it from Equifax. And then the final 4 months of the year, they would get it from TransUnion. That way, throughout the course of the year, an individual can track and see exactly what's being reported to them, and can take any action that they would need. And so the addresses and the website information and the phone numbers of these agencies are contained in page 8 of the packet, which everyone was supplied at the before our discussion here began. And so the next page, if you want to kind of look through with me as I go along, are sample copies of what the credit reports look like. So on page 9, you would see that it starts off with consumer information about you, your name, your address, things of that nature. The next would be a statement that you as a consumer could enter into that report. You are allowed to make a statement up to 100 words, to make a statement about what you feel your history is or whatever. The next section that you'll see is a summary of information that is kind of a consolidated look at what your outstanding debt balances are. The next section, the fourth section, contains an account history information where it looks at different major debts outstanding and also looks at payment histories for 2 years on a month-by-month basis. And if you look closely at that, you'll see that some of those little boxes representing months say clear on them. There are some that are a little bit darker that would say maybe 30 days, 60 days, 90 days. Those are recordings of, in those months, you were those number of days late. And then it's summarized right at the bottom of that. The next section is that contains public record information, because not only is your payment history against credit cards saved and obtained and saved, also court rulings, of outstanding debt. If you've had a judgment against you, if you've had liens put on you, if you've been sued, or there's any sort of outstanding legal debts that you owe that wouldn't normally be on a credit card. The next thing is that anytime a potential lender inquires about your credit report, that is recorded also, and that appears in the next section called inquiry information. And then there's creditor information, where there's information about the companies, the specific companies that have lent you money. So that's your credit report, your credit history. And as I mentioned, the three agencies are required to give you or provide you with a copy free annually of at least one report. And that information that was contained, I think, was on page 8, shows you how to contact them. Now, in addition to your credit report or your credit history, there's also something used that I think most people are familiar with called the credit score. And there are different, different types of reports that are available. The most common one seems to be the FICO report. And that reports gives you a grade between 300 and 850, which is kind of a measure of how good of a payer, a borrower you are, and what your history is. And and there are different categories. There's different ways to look at that credit score. If you have a credit score of 800 and above, lenders view you as an excellent person to lend to. You're an excellent borrower. From 740 to 799, lenders view you as a dependable, borrower, and more than willing usually to lend to you. 670 to 739, most lenders consider that to be a good score and will also work with you in providing credit. Now, 580 to 669, some lenders will approve you, but other lenders might not. They might consider you a risk. And if it's 579 or below, lenders view you as a very risky borrower. So, and where does that credit score come from? The credit score is made up of 30% of determined by how much you owe, your current debt balances. 35% they consider the payment history. 10% looks at your maximum credit allowed. 15% looks at the length of time that you've had credit, and 10% looks at whether it's a new credit card or not. So there are a statute of limitations on items that appear on your credit report and credit history. And this is a question that a lot of people ask. They'll say, oh, how long does it stay on my record if I, missed a payment or I paid late after 30 days? And so the next section I want to talk about is how long, what the statute of limitations is. If you have open accounts in good standing, they stay on your credit report indefinitely. They stay on there forever. If you've closed accounts in good standing, the history stays there for 10 years from the date of the closing. If you have a late or missed payment, that stays on there 7 years from the date of the delinquency. If you've had collections or charge-offs, that also stays on your report for 7 years from the date of the charge-off. If you file Chapter 7 bankruptcy, that stays on your credit report, your credit history for 10 years. Chapter 13 bankruptcy is the same, 10 years. If there are civil judgments against you, that depends on local state statutes, so they could vary depending on the state. If there's a foreclosure, say you've owned a house and you've had a mortgage, you've been unable to pay, and the bank forecloses or the lender forecloses, that's going to stay on your credit report, your credit history, 7 years from the date of the foreclosure. Federal student loans and tax liens stay on your report for 7 years from the date that you paid. If unpaid, there's no limit of how long they could stay on there. And if somebody inquires about your credit, your report or your credit history, that inquiry would stay on the record for 2 years. Now, I mentioned earlier that you can improve your credit if you work on it, and one of the ways would be to establish a credit improvement plan. And the next page that was in your packet on page 16 shows a step-by-step type of a credit improvement plan. It would start with ordering your credit report just to see what's on there so that you know. Review it for accuracy. If there are things on it that are inaccurate, you dispute those, and they can be removed by that person. You contact them, you say, this is wrong, I paid that off, it should be removed, and they're obligated to remove it. And sometimes they drag their feet, but they should remove it. The next thing would be is if there is a negative statement. I mentioned, right at the very beginning on the credit report that there's a section for the consumer's comments. You have up to 100 words where you can describe what, if you feel that there was a valid reason that you made a mistake, you paid late or something like that. Like currently with the COVID thing, if you were on layoff and the layoff or furlough continued longer than any of the public benefits that you've been entitled to, and all of a sudden you find yourself totally without funds and you can't make a payment, you can enter that in the that consumer statement section. So you can also add positive information. You're expecting a big bonus, or you're in the process of selling something expensive, and you're going to have proceeds. You're going to pay off everything. But you can view down that list, and you can see the different steps that you can do to have a credit improvement plan. In a different section, of this discussion, we will talk about how to improve credit scores. Now, the importance of your credit scores is shown on the next page. If you make mistakes, and say you start off with a credit score of 680 or even 780, if you maxed out your credit card, if your score was 680 before, your FICO score is going to go down 10 to 30 points. If your score was 780, it's going to go down 25 to 45 points. For each type of mistake that's made, a 30-day late could go down 60 to 80 points. Debt settlements could reduce go down 45 to 65 points. Foreclosure reduces the number of your credit score points. Bankruptcy also. So how does that really affect, these scores? Are they just numbers? No, they really affect how much you have to pay for things. And for example, on a car loan payment, if your score was 710 points and your loan at that rate was 5.67%. If you had a 30-day late payment, your interest rate would jump almost double to 10.75%, which would mean that all of a sudden now you're paying 5.1% higher interest rate. And that would also apply if you're applying for the car loan before you've purchased it. Instead of being a lower rate, it's a higher rate. How about a mortgage? A mortgage, if you had a good score, an excellent score of 710 points, and you had a 30-day late payment, the type of mortgage you would be approved for would be 4.6%, which is 1.367% higher, which would mean that normally on your original score, your monthly payment would be approximately $654. Instead, it would be $771, which is $117 more per month. That equates on a $200,000 mortgage, 30-year standard, would be $42,000 approximately more that you would have to pay. That's a significant amount of money, that you've paid extra by having the poorer score. So it's important to maintain that the cost of that credit. So I also want to talk about credit cards themselves. They are required by the Consumer Protection Act on every credit card statement that is sent to you to have a section for information that tells you the percentage rate that you would pay on outstanding balances. It must contain the amount on a typical dollar amount, how much you would pay at that interest rate, how much more you would pay for the use of the credit. It would have tell you what the fees are if you have late payments. It would tell you the fees if you've paid with a check with insufficient funds. So it's an important thing to become familiar with that, to know. And obviously you want to go out for and obtain credit cards that have the lowest possible interest rate. And it's also very important to pay on time. The last section that I want to talk about in this short section is the different types of credit cards there are. There are fixed rate credit cards. There are variable rate credit cards that vary with, that may have an introductory rate that's low, and after a certain length of time it jumps up, it's higher. They have gold, platinum, and titanium cards where you might have to pay something for the card, but they would give you extra benefits, either higher a higher, maximum allowed of credit, or perhaps additional goods and services. They have incentive cards, to get you perhaps for spending so much, you get frequent flyer miles. Uh, you have incentive cards that perhaps give you cashback credit money if you spend it on different categories. And also, there's secured cards where you put up so much money, usually in the way of perhaps a bank account, like a debit card, where they subtract as they go along. So the topic of credit and credit cards and credit scores and improving credit, it's a pretty lengthy discussion. So for this video session, I'm going to terminate it now, and there will be a follow-up to this that will talk about how to improve and have plans for reducing, reducing the amount of your debt over a period of time, how to improve your credit scores, things to watch out for. Talk a little bit also about the threats of stealing your credit information and using your credit card, or your identity, fraudulently. So that will be in the next session. So I'm going to conclude for now this section, and again there will be a second section to be done. That hopefully, so sessions don't run really long. We have limited time on these videos. So thank you very much, and we'll talk to you later.